Hey everyone, welcome to this live webinar. So with me today is Victor. I'm Adam. I'm the editor-in-chief and a co-founder of Fifth Hangout. And with me is Victor Chng. Hi, Victor.
Hi, everyone.
Alright, so before we begin, I just want to make sure that everyone can see our two faces on the screen and basically hear our voices. So if everything sounds good and you can see us really clearly, just type it in the message box and let us know.
Yeah, just type yes to let us know that you can see us.
Okay, so I think you can hear our voices loud and clear and you can see us on the screen. So welcome everyone to this live webinar. So what you're seeing in front of you is live. This is really me and this is really Victor.
Yeah, that's me, that's my face.
Okay, so these are real people, okay? So this is in our office and today we're going to do a live Q&A webinar with all the questions that you submitted. So we received a lot of questions from a lot of you. We had over 300 people register for this live webinar. So as you can imagine, we received a lot of questions. So we picked the best questions that we felt would give the most value to all our listeners today. And Victor's going to answer them, right, Victor?
Yeah, I'm going to answer everything.
So we've been through some of the questions, and Victor's going to answer them. And I'll go through the list basically. And as we go through this program over the next half an hour or so, feel free to type in any additional questions that you have in the chat box as well. And if we feel that it's relevant, we'll ask them as well. Okay, so with that, are you ready, Victor?
Oh, I'm ready.
Okay, let's go. So, a lot of questions. All right, so this question is from David. So his question is, in order to maximize the gain, do you think it is a good idea to sell a stock to secure the capital gain under the following conditions? All right, so when most of the indices are at a peak, so when the markets are really expensive, all right, so this is one of them. Should I go through everything? Or should I go through one by one?
Okay, I'll just talk about this first.
Okay, so should you sell a stock when the markets are really expensive?
Definitely, because all your stocks will be very, very expensive. But the issue is, can you really time it that well?
All right.
Sometimes the market may be expensive.
Yeah.
You sell it, but it goes further upwards.
All right.
So you can do this strategy, just that when it goes further upwards, you have to be more emotion stable about it. Don't go buy back at a higher price.
All right. So what if the markets are expensive, but the stock it's not exactly overvalued yet? What do you do then?
Okay, then I will still hold the company. I will still hold the stocks. Okay, if it's still undervalued. Okay, but if the stock is overvalued, the market is overvalued, most probably I will sell it off.
But the overall market just basically gives you an overall indication of how expensive stocks are out there.
Okay, to my experience, is most of the time, right, if the whole index is very expensive around the whole world, right, the stocks, right, will generally be actually quite, there will be less undervalued company, I would say. Okay. So during the different cycle of the markets, right, during the crash, there will be more undervalued companies. During the boom, there will be much lesser.
Okay.
So that's the characteristic of the market. Yeah.
All right. So the next condition is, do you sell a stock if the dividend yield is really, really low? So then basically the price has gone up and the yield is really low. What do you do then? Okay.
For me, I don't really look at dividend yield to gauge, unless you are a dividend investor. Yes, if the yield drop to the historical low yield, you probably have to sell it. Okay. But I'm more towards buying for growth. So I will calculate the intrinsic value of the company. So if it's way above and way over value, I will sell the company.
All right.
Okay.
But then if you're a dividend investor, you may want to keep it for dividends even if it goes really expensive, right?
Yes, definitely. So it depends on
what your strategy is.
What your strategy and what kind of character are you. Okay. Some for instance, some investors they don't want to do anything, they just leave it. It's okay. It's okay. You're still getting good dividends out of that. Yeah.
All right. Okay. So next question is the next condition is, now it's on the other side. Do you sell a stock? Let's say you made a gain on the stock, but then the markets are at the bottom. You know, the markets are really, really cheap. Do you sell a stock then?
When the market is very, very cheap, I don't sell the stocks. I will buy the stocks.
You'll buy more.
I'll keep buying and buying and buying.
Okay.
Right. So for instance, like I remember around last year before August, we are still holding about 40% cash in our funds. Okay. And we are so happy when the China stock market crashed. Okay. So that caused the market to tumble. And also December, the oil shock crisis. Okay. The oil price started to crash. So the market became very cheap at that moment. So Rusmin and I have been buying very heavily from December all the way to January. Okay. and we have literally deployed all our cash, and we left with I think 3% only. Okay, and now the index is going down. We are always going up because we buy at a very cheap price. Okay, and now the index start to go up, we go even higher. So you can see that our funds performance and the index start to gap up. Okay, so that's how you make money. You have to buy when everything is in panic mode. Okay.
Okay. So basically, you're saying now our fund is actually is beating the index.
It's beating the index. Okay. It's beating the index all the while.
All right. Yeah. I just want to. I think I forgot to do this earlier. It's basically this is a disclaimer. So basically, we're not giving any investment advice, or we're not making any recommendation to purchase or sell any single stock. So we're just sharing from our personal experience how basically we invest. All right. So please take it as an educational video. Okay. So no recommendations, and we won't give you any recommendations as well. Okay. So let's move on to our next question by Pokey. All right. So here's the whole question. I'm not sure. Okay. So question is, in the US, all three indices are at record highs, but the STI is not really reacting. Okay, so how long can this situation sustain?
Okay, basically I can't predict the market. I don't know how the market will move. Okay, you're right that the three index in the US is expensive right now. Okay, but the STI and the Hong Kong regions are generally much cheaper than compared to the whole Asia region, which is why Will Smith and I have heavy investment in Singapore and in Hong Kong especially. Okay, I do not know when the index will turn, but what I know is when the company continue to perform during good market condition, they tend to pay higher dividends. So when they pay higher dividends, there's much higher yield. You attract more investor into the company. So when there's more investor into the company, the share price will go up, and that's where they push the whole index of SGX and Hang Seng index up. Okay.
All right. So I hope that answers your question. So let's go on to the next question by Uma. I think she says, I have about 20 stocks in my portfolio. Okay, I have some blue chips bought in the 1990s and early 2000s, purchased at a very low price. For example, like SGX at $1.50.
Well, that's a very good. Congratulations.
Congratulations.
Yeah, that's a good price.
So my question is, if I want to invest fresh funds, then do I look for? Wait a minute. Okay, let me just read this question. I need to edit this in my mind. Okay, so my question is, if I want to invest fresh funds, do I look for new companies? Because it's going to be difficult for me to monitor more stocks, right? All right, and all the blue chips are way above my buying price. So is it a wise idea to average up what on the stocks I already own? And how many stocks in the portfolio is an ideal number?
Okay, firstly, keep your SGX. That's a very good price. Okay. Secondly, definitely you have to find new companies because all the blue chips have gone up. You have to do your own valuation on this. The question is, how many stocks should you have?
Yeah, how many stocks should have? What's the ideal number in the portfolio?
Okay, generally for a retail investor, I think ideally you should have between 5 to 30 stocks. Okay, but if you are those who have limited time, I think you should be less than 20 stocks or probably less than 10 stocks. Okay, but of course, if you like Uma who have bought all these good blue chip stocks at the earlier price, which is a very good price,
like 20 years ago.
20 years ago, right? I think you can continue add on, but you add on to much better companies. But you remember to keep it at maximum 30, because when it goes above that, it's a headache to track all of them yearly.
Okay, so let's move on to some of the live questions that you're asking right now in the chat, which are pretty relevant to what we're discussing right now. So how do you gauge if a stock market is generally overvalued or undervalued?
I look at the market PE and PB of the index. Okay, so if you look at S&P 500, okay, generally they are at the overvaluation time is when they are above 20 times PE. So currently I think they are about 20 PEs. So they can move up even higher also. Okay, generally undervalue is like below 10 times. On average, fair value is about 15 times PE. So this applies to all the market in the world. Okay.
Okay. There's another question here. What if the markets continue to drop after you bought heavily? Okay,
that's what happened to us also. Okay, so when we want to buy to a certain companies, right, we allocate the capital. So let's say we tell myself that, okay, I only can invest 5% in this company. So Rusmi and I, we will allocate 3%, 2 to 3% to this company first. Okay. So when it drop down 10 to 20%, we will allocate the other 1%. And when it drop down another 10 to 20%, we will allocate another 1%. So that's how we average down our holdings into when we invest in much better companies. We don't panic, we just keep buying money. And now we are seeing the result right now. Exactly.
Okay. So let's move on to another bunch of questions by Yogi. Okay. So what are the specific ratios to look out for in REITs, industrials, food infrastructure, and I think companies in general?
I think ratios in REITs, right? I think
ratios. Yeah.
Okay.
Ratios.
Basically, if REITs, you probably want to take a look at their property yield. That's very important. Their debt level also. Their probably is debt to assets. That's for the REITs. For food companies, right? Generally, you should look at their margins. How are they performing? In terms of Singapore food, when I'm talking about, because Singapore food margins are generally much lesser in the single digit. So it's very important to see how they control the costs, right?
Okay. Basically, is there anything else you want to cover? Industrials, infrastructure, companies in general?
Companies in general, I tend to look for cash-rich companies that are having a net cash position. That will be, you'll be in a very good position when you invest in them. This is the first thing. But of course, you don't choose in those S-chip companies, the China listed companies, because the cash is disappeared in the later part of their listed.
Right. Yeah. So in general, if you actually want to know how Victor, Rusmin, and all of us here basically do our ratios, what ratios we use, and how we basically look at the financials. Basically, we have something called investment quadrant, and there's one module there where this is entire flow chart that we actually use to analyze all the ratios. So basically, if you want, you can check that out.
Yeah.
Okay. All right. So another question: with a lower economic outlook, lower dividend and interest, which sectors and strategies should be looked at for a 3-year or 7-year horizon?
Okay. Personally, I don't really focus on sectors. Okay. I go to places where there's cheap. Then I start to screen the whole countries for the stock. So for instance, one period of time, Hong Kong market was cheap. So Rusmi and I was spending our time in Hong Kong market screening for companies, good companies, fundamentally strong. But we don't focus on any sectors in our thing, and we don't really predict the next 3 to 7 years how the market is going to go, because we can't really predict. Usually, I always try to bet with Rusmi. Okay, let's bet that this market will go this way, and I'm always wrong. I must tell you.
So what do you bet on?
Always bet lah. Say that the market is going to
go.
Yeah,
what do you bet? What do you lose?
No lah, we just bet probably a drink and all something. Yeah. So you can't predict the market, because the whole market is very dynamic. Even Charlie Munger, the friend of Warren Buffett, also said that the whole market is very dynamic, and there's too many indicators that move and moving parts that move the whole markets. So you literally can't predict the markets.
Right. Yeah. Okay. Next question: is ETF a good opportunity, or are valuations too high for ETF investments?
Okay, so just now remember I talked about the market PE. How do you track the undervalue, overvalue, fair value? So you use that to invest into ETF for the index. Okay, I generally those people who I would say lazy investor, I'll recommend them to go to the ETF. It's much simpler and you don't need to do so much work. Okay, but of course the return is much lesser than the investing in the stocks. Depends on the country. So probably, let's say you talk about Asia region, if you invest in index, probably it's about 7 to maybe you're lucky you can get 12. So that's the range that you will get for index. Yeah,
historically.
In the long run.
Yeah. So anyway, there are many kinds of ETFs. So some ETFs focus on indices. So there's some ETFs that focus on certain sectors, certain industries. Some ETFs focus on commodities as well. So it really depends on the type of ETFs that you are going to invest in. Each one has its own ways of valuation. So
but what I'm talking just now is just an index. That's an index.
Index ETFs. Okay, so based on PE, that sort of ratios. Okay. How active a portfolio management do you recommend?
Actually, I'm not very active. I very seldom change my stocks. So probably once a year I will check whether the companies are still fundamentally down there. Okay, every year. So if it is, I will just leave it. Most of the time, probably, if I were to change the stock, it's probably 5 years. Once or probably 3 years. So depends on the type of investing that I'm doing. So if I do special situation, usually it's faster, it's 3 years. But if I do the long term one, probably is 7 to 10 years, or probably I will hold it forever. But if I'm doing those riding the growth one, right, probably is most likely is 5 years. Right. So it depends also. Sometimes I sell in 1 year also. So it depends on the type of strategy that you are using, and that's how how active your portfolio. But of course, if you tell me you're doing trading, then every month you're active in your portfolio.
Okay. Let's move on. So Gregory asks, should I keep a trade journal? If so, what should I record in the journal?
Okay, you should keep an investing journal, not a trade journal. Okay, depends on.
I mean, it's the same thing. Like
yeah, but it depends on the stuff. I'm just making a joke. Okay, yeah. So yes, you should. Okay, yeah. So what usually I do is I create a portfolio that I track my returns on every single stock. This is the first thing. Second thing is I will encourage you to write down the reason in that journal why you buy the stocks. Okay, so every year you go back to the stocks and you look back at the company and check whether the reasons is still valid. If the reason is still valid, stay invested in the stocks. Okay, but if the reason is off, I would say that it's time to reshuffle that portfolio and find better companies. Yeah.
And it's also useful if you make a mistake.
Yes.
To write it down and realize how come this stock went in
the
other direction.
Yeah,
and then you have a learning lesson.
Yeah, write down a mistake. I can tell you, I learned most of my investing making mistake. Okay, when I just started, nobody tells me what to do and how to do. I make mistake and I learn from there, and that's where I pick up. So literally, I'm telling you our mistake most of the time. So that's where you can learn and cut short the learning curve, and you will be a better investor much faster than me. Yeah.
Okay. Let's move on to the next question. So I'll keep this guy's name private. So because it's a bit more sensitive maybe. So recently I received a legal letter from a New York law firm stating that China Fishery is filing for bankruptcy protection. So as a small-time investor, I've lost all my investment. So other than that, what are my liabilities in the worst case?
Okay, if I not guess wrongly, because the company is a listed company, so it's exactly like you owning it. You know, when you open a private limited company in Singapore, so they sue the company, but they don't sue you individually. So the company go bankrupt, but not you. So you are still okay. So, and moreover, this is a listed company, so I believe that there will be no issue on you. You just lost all your money. That's all.
Yeah. So basically, there's no liability.
Yeah, there's no liability.
But you lost it.
Yeah, but if you're still afraid, okay, I would suggest that you go and consult a lawyer.
Yeah, this is not legal advice. Yeah. Please don't. We're not lawyers.
Yeah.
Basically, we're not sure this.
I'm not a lawyer. I'm an investor.
Yeah, go seek a legal advice from the lawyer. Okay.
Okay.
Mahendran has a question. What is the future of S-REITs in 1 year? Can you predict?
I seriously can't predict. But of course, the governments have not the government. Is it the MAS? I think the MAS has set quite a lot of favorable rules to the advantage of S-REIT. So in general, I think moving forward, I suspect there will be more and more REITs coming.
Okay. All right, let's move on to Adrian. He has a question. When trying to evaluate a company, we usually try to benchmark its ratios against its peers. So what resources would you recommend to find all this information?
Actually, basically, when I analyze the peers, I'll read every single one of their annual reports. Any competitor that I can find. Yeah. So I will see every competitor, what are the PE range that they are trading at. So that's how I compare.
So Victor is an old school investor.
Yeah.
He literally reads every single annual report that he can get his hands on.
Yeah.
That's what he's doing.
Yeah, so I mean, but if you really want, and I plot out the PE myself and all this kind of thing, and the benchmark ratios and all this kind of thing. But if you want it to be faster, there's this thing called the Bloomberg Terminal, but it costs you about 2,000 a month for that. So as a retail investor, it's not worth for you. I think you should sacrifice a bit of your time and save the 2,000 a month to do more work. And I can tell you, when you start doing all the work, reading all the annual reports, right, you'll get a very clear understanding of the company, and that's where your confidence comes in. And you must know that when the Bloomberg they draw data, it's third-party people drawing the data, and sometimes they may be wrong. Okay.
Yeah. All right. So if you want a free resource, I actually use Morningstar a lot. So they actually list out the peers for you, but they don't list out every single ratio. They usually compare the valuation ratios across competitors. Yeah. And then of course, when you know which peers they are basically benchmarking against, you can check out what their individual ratios are as well. So you can do that as well if you want.
You can go back to the floor, the live questions.
Oh, live questions. Go back to the live wants some live questions.
Yeah.
I shall say okay. All right. What screener do you use to filter, stocks and fit your investment criteria? What filter do you use?
What screener?
Yeah, what screener do you use?
What screener do I use? Okay, basically I like one screener, but I felt it's one of the best screener and it's free. It's CIMB Securities. Okay, so far their screener I felt is the most user friendly, and they can screen almost every market in Asia and also the US. So you can look at CIB Security, but you have to be a client for them. Okay, I don't recommend them. I mean, as in, not don't recommend them. They don't pay me to recommend them. Okay, yeah.
Oh, I just use them myself.
I just use them myself. Yes.
All right. So when you use P ratios, you use historical or forward ratios for PE.
As in for the market, or there's a lot of
for okay, let's say for a company. You use the historical?
Historical. I don't use forward because forward P's there's a lot of projection. Yeah. I don't believe in prediction.
Yeah. So what you can use something called a TTM. So it's a trailing 12 months.
Yeah. TTM is a good one.
That's the most.
They call it growing P.
Yeah.
Growing P. That's the P that I usually use. Yeah.
Okay. How do you know book value is authentic and true? How do you verify?
How do I verify book value is authentic and true? Okay. It depends on what kind of company that you are analyzing, and also
so it depends on the kind of assets that the company
has.
Yes,
the kind of assets that a company has. Usually I like to, let's say if a property company, right, then probably you have to go check the value of the properties real life by calling the agent and check what's the surrounding PSF of the property near the property that the listed company owned. Okay. Other than that, usually I don't really question the financial when I felt that the management is trustworthy. So that's why I spend a lot of time assessing the management, finding whether the management is honest and all this kind of thing, so that they won't cheat on the financials.
Okay.
All right. Okay. Now we're back to the question.
Let's go back to the questions. Submitted. So if you're starting small, let's say you just have $5,000 to invest. Should we apportion our portfolio or put it all in a single stock or ETF?
Okay, when you just start out with 5,000, my take is first, do you have emergency money, emergency funds? So make sure you clear off your emergency funds, whatever assets that you take to invest. Okay, so 5,000, right? When you invest, I will suggest that you invest in one stock only. Okay, but of course, monthly you are saving the money, all this kind of thing, right? So when you save the money, okay, then monthly you take let's say you save another 5,000. You don't go back and buy back the same stock. You go buy another stock. So your portfolio will start increasing. So in the past, I started with buying one company. Slowly I save up more money. Then I buy another company. Then I save up more money. I buy another company. So that's what I do. You try to, as a normal retail investor, try to diversify to about, let's say at least 5 minimum to 30. I would say. But if you just started out, probably is 8 to 10. I would say.
Okay. I actually have a different strategy. I wouldn't put 5,000 straight away in one stock. Because you're going to be really sure about this stock.
Yeah. I mean, I do a lot of my homework.
He does his homework. So, but if you're not 100% sure, maybe it's up.
Then you put it in ETF.
ETF, or you may still
ETF. If you put down in ETF and you hold it a long run, generally there's not much issue for ETF. But you must hold it for a long run.
Okay. In terms of dividend income, should we look at REITs or other dividend or defensive stocks like telcos, etc.? If it's REITs, which subsector of REITs looks good at the moment?
Okay, REITs is good, I'll say. If you tell me I won't tell you which sector to look at, but I'll tell you which sector not to look at right now. Okay, so I'll avoid industrial. Okay, because the government has changed the rule. So now the year will be like less than I think less than 30 years or something like that. The leases, yeah. So I'll avoid industrial. It's very tough. For our next, I'll avoid office because oversupply is coming. So office is going to have a tough time. But I'll look at them when they are in a very bad condition. Okay, so now they are going towards a bad condition. So avoid office. And that the rest of the sectors generally are quite still resilient and much better.
Okay, all right. Let's move on. So Mark has a question. I'm increasingly interested in investing overseas, in particular Hong Kong and the US. So I understand the US has capital gains tax and might not be worth it in terms of dividend growth. How about Hong Kong? What do you think?
Hong Kong, I can't remember Hong Kong have tax.
Okay, from what I know about the US, so the US has no capital gains tax if you're a foreigner living in Singapore, for example.
If you live in Singapore, there's no capital gains tax, but there's dividend gain tax.
Yeah. So I invest in the US, so there's no capital gains tax for your US stocks, but there's a 30% withholding tax for your dividends. So basically, they just automatically deduct this before you even see your dividends. So you only receive 7% dividends. So if you're going to invest in the US for dividend growth, it could be a bit challenging because it's a huge tax rate for dividends. So usually I invest in the US for capital gains only. All right. And the other thing, of course, is that there's estate duty. So if you happen to die or invested in the US, the government can technically, I think, get up to half of your assets in the US, which includes your stocks over there. So again, seek someone who knows how to handle all this for you. There's a lawyer that specializes in this. All right.
I think Hong Kong there's no tax. I don't remember I getting tax. It's only those custodial fee only.
Yeah, I don't know, because Hong Kong is very similar.
I know Thailand there's a 10%.
Yeah. All right. So let's move on to another question. I've attended classes on fundamental analysis, technical analysis, and value investing, but to follow all of that requires a lot of time and effort. So is there a shortcut to investing? What practical guidance can you give to full-time employees who wish to put some of their hard-earned money into investing?
There's no shortcut to investing. This is a very tricky question, but honestly, there's no shortcut to investing because investing.
We are the shortcut.
We are the shortcut. If you talk about,
we read our blog, join our stuff.
We are the shortcut.
You say, but basically, there's no real shortcut.
There is no real shortcut. No, there's alpha.
Alpha.
No, just joking. Okay. If you are really do not want to do analysis, don't do any work, I would suggest that you invest in the index. Yeah. Don't go to the stocks because stocks really require work, require time. If you don't want to do work, don't want to do time, go to the index, the ETF. Okay.
Okay. So there's another question. With a portfolio of a few winners and many losers, how do you proceed to turn this portfolio around?
Okay, this is a very simple question because I've done this before. Okay, if you know us, Rusmin and I used to manage a money losing fund. Okay, we managed to turn around. Okay, the key to turning around a portfolio is to clear your loser. You must have this mentality that if you continue to hold your loser, let's say I got this, I invest $10,000 in this company and it's a loser, and I know that in 10 years down the road the company will continue to deteriorate. So and now it's like, let's say 7,000. Do you cut it or do you still hold it? I'll cut it because I know 10 years down the road this company will worth even less than 7,000. So I will cut it and put it back to a winner. Let's say I cut it out and I invest the 7,000 in a winner that can compound about 10 to 20% yearly. Then I will get back my initial losses, and 10 years down the road I will even get higher returns. So why do you want to keep a bad stock and compound your losses?
Basically, there's an opportunity cost.
Yes.
Right. If you keep the money in a bad stock, you miss out on the gains that a good stock can give you.
So you must compound your gains. You don't compound your losses. So for me, if I were you, I'll clear all my personally, I will clear all my companies, not because the company lost money, but because fundamentally it's not strong. Okay, I know that 10 years down the road, they will go into a very bad situation. I'll clear it off and put it back to all the winners that I felt is fundamentally good and is undervalued. Okay,
let's move on. Kelvin has a question. So, do you believe in time in the market or timing the market?
Well, okay. Basically, I don't really time the market, but I see what the market gives me. If the market is overvalued, definitely I will sell. Okay, my stocks is overvalued, I will sell. So far I don't hold forever. So far at this time of my investment. Okay, but I will buy it back when it's cheap again. So because I know the company fundamentally are good. Okay, so yeah. Okay. But probably you can say that I don't really time the market.
You don't really time, but just kind of see overall value.
Yeah, overall value of the market and the overall value of the stocks also.
Okay, let's move on to a question by Ricky. So he has concerns about the high cost of investing in overseas markets, for example, Malaysia, Hong Kong, and the US, due to the custodian fees and handling fees. Any broker to recommend?
Okay, all the broker is the same, so you have to pay the custodian fee. Even for us, we also pay, just that we got much better rate because our brokers are institutional brokers. So you have to be above $1 million that you can get them. If you are above $1 million, you can go to the institutional broker at Chng. Okay, that I'll recommend. If not, if you want to save money on all these custodian, right, go to the individual company. Go to the individual countries and open a brokerage account. That will be much cheaper.
All right. So Andrew has said that there's no tax in Hong Kong.
Oh, there's no tax. So thanks, Andrew.
You should. Yeah, we don't pay.
Yeah, I don't really check it. So, yeah.
All right. So let's see if there are any other live questions that are coming in. Do you think the UK is a bargain since the Brexit has been going over?
Actually, I don't invest so far, so I'm not really sure whether it's a bargain or not.
So
right now.
I don't basically, because this is outside of my circle of competence, so I don't touch it.
Yeah, I'm more of an Asia investor, and some stocks in US, and that where I do more special situations.
Okay. This is a good question by Fan Yang. So what are cases where you've done 100% of your homework, but the performance just didn't perform in the end, and what do you learn from those cases? Okay,
this thing always happen. You always thought that you do a lot, but you always miss out certain things. But when things turn bad, right, usually we don't lose that much because we buy with a margin. So that's very important. The lesson I learned is you have to always buy with a margin because the margins helps you buffer for the error. Okay, so once you have a margin, even though you sometimes I've got one scenario where we bought into a company, we make a mistake, but because we buy a very high margin, we still make a profit. So the margin of safety is very important. That's my lesson I learned.
All right. So there's another question here. Are you confident with your thesis to hold a cut loss when the stock you invest in? Let's say you invest in the stock, and it goes down 10, 20, 30%. Are you confident to hold on to it? Does it still hold?
Yes, of course. You look, Breadtalk is a one case study. We used to buy at 60 cents. It drops all the way down to 50 cents. We went back to check the fundamental, or it's still there. Okay, but it didn't drop a lot to us. So when it dropped to 45 cents, then we were still looking at stock. Fundamentally, it's still cheap, so we went to bought it. And where's Breadtalk? It went as high as 140, right? And now it's back to $1, I think. So that's the conviction that we do, right? We do buy down also.
And that only comes from
sometimes the stocks that we buy, it went down like 30%. We are not afraid. That we will average out. Average down. Yeah.
Okay. All right, let's move on. So Hanyo has a question. How do you find out more about the business model of a company, for example, like ARA Asset Management? How do you find out the portion of the revenues are recurring, etc.? How do you find out?
Okay, anyway, ARA, they always mentioned in their annual report that the revenues are recurring. One large portion. Another portion is you should go to read how the companies actually make money. You must understand the business. Let's talk about let's say Kingsman Creative. Let's talk about Kingsman Creative. One portion of their business is exhibition. Okay, so basically they help to build the booth for the exhibition. And if you think about it, how they make money is when they build the booth, right? People pay them 50% down payment first. When they complete, then they pay the rest of the payment. So and exhibitions, do they happen yearly or every 10 years once?
Yeah, many times a year.
Many times a year, and usually the same exhibition will happen yearly or every 2 years. Okay, so is there a form of recurring for that? I'll say yes. This is how I look at recurring. That means does the revenue keep coming back, or do they have to keep hunting for new customers to be growing better and better? Okay.
All right, Russell has a question. There are many ways to calculate the intrinsic value of a company. Which one is the best? Should a different method be used for a different type of business?
Okay, there's no best valuation method to calculate the intrinsic value. Why? Because different companies, right, requires different valuation methods. Okay, so let's say if I were to want to invest in do a valuation on Raffles Medical. Okay, if I use the DCF model, okay, it will show that it's overvalued because DCF model probably is a 10 years. It will show that it's overvalued. Okay, a 10 years DCF model, I would say. But for Raffles Medical, you should use a PE. Okay, because they have much predictable and everybody knows about Raffles Medical. So there's a certain PE tag to this company. So you have to find their average PE for Raffles Medical and try to buy at the average or below the average.
Yeah, I can give you the same example about Starbucks. I mean, Starbucks has been trading around PE about 20, 27,
Yeah.
32, 33
Yeah.
for the last 5 years. So if it ever goes down to 20, I'm going to have a look. But also, I'll be worried about why it's gone down to 20 as well. But you look at the historical PE bands where the stock is trading. This one we look at the companies as well. All right. So let's go on to another question by Karina. How do you generate investment ideas?
Okay, usually what I do is I screen companies.
Okay.
So I screen companies that pass certain ratios based on debts, ROE, and all this in the different region of the company using CIMB. Another way I find ideas, which most of the time I found it, is reading newspaper, reading The Age. You know The Age, okay? Singapore and Malaysia have The Age, and that's a very, very good. Most of the time I find some ideas from there. Newspaper is a very important source, and another type is magazine. But of course, you don't read magazine nowadays, so probably you can read online, go join some investment forums, and when people talk about it, you can go check out on the company. Yeah.
Okay. Which method is better, deep value investing or value growth investing, which means buying a great company in a
Okay, there's no good best method, but it's how you execute individual methods. Okay, every method produces results. Okay, and you have to follow the system to do it, because deep value there's a system, value growth there's a system. So you have to follow tightly to the system. But for us, right, we use both this method. Okay, a large percentage of our stocks are all value growth, and the minority percentage are all deep value, and both perform equally well. Okay, so there's no good and bad on.
So it depends on the thesis.
Yes, you have to follow the system. So when we invest in deep value companies, we follow the deep value system. Right. We follow when we invest in value growth, we follow value growth system.
Okay.
Okay.
Let's move on. This lady has a question. So MRT, as we all know, is going to be acquired by the government.
Yes, correct.
The government. Yeah. So the acquisition price is $1.68. So why is it trading below $1.68?
Okay. Usually there's always be about 5 cent or 10 cent difference in the target, as in the takeover price and the share price, because investor will have a buffer down there that in case this never happened, that means the takeover didn't happen. So there's always this buffer. So it's always happening. Okay. All right.
There's a saying. This is the question. There's a saying that when you reach retirement, you shift majority of your portfolio to unit trusts or ETFs or mutual funds. Okay. So, what do you think?
Okay, firstly, never shift your portfolio to unit trust. You'll definitely lose money.
Very expensive.
Yeah, because of their management fee.
Fees,
I guarantee you, because 99% of the unit trusts don't make money because of the fee. Okay, mutual funds, select value funds with the low cost one. Okay, shift to ETF. Okay, you can do it. But usually what I do, I'll still manage an equity portfolio even though I'm a return, because I realize that equity portfolio gives the best dividend, and that's where your passive income is. Okay.
All right. Let's move on to some of the live questions. How about that?
Yeah.
All right. Let's see. If you already own a share and you want to keep on adding, what is your typical strategy? Do you wait? Do you time it, or do you buy as a certain drop in percentage?
Very good question.
By recent, yeah.
If you own a share, you want to keep on adding it. Okay, if I own a share, right, I will gradually increase my position in them if the company is still undervalued. Okay, but if it's not undervalued, generally I will hold it.
Okay. All right, let's move on to some more questions. Okay, we really can't cover everything. There's so many questions you guys sent us. We're going to wrap up in the next 5 minutes, 5 to 10 minutes, and we just cover as many as we can. And don't worry if your question is not being covered today, because we're going to have more of these sessions in the future. We'll let you know when it happens again. There's no scheduled date at the moment, but let's cover as much as we can right now. So let's see. Is there anything that you want in particular, Victor? Okay, how about this one? How do you perform company research in overseas markets which are far away and not familiar?
Okay, if you want to invest overseas, right, you have to read their annual report. That's first thing very important. And second thing is to look for any publication that actually interview the management. Okay, but I still encourage you to go down on the ground in the overseas, right, to see, let's say if you're a consumer product, go down and take a look at how the business is actually running. That's very important. If not, I would say that you stay within. If you don't want to do all this, you should stay within the region. Okay, but if you are afraid that you can't do enough work, but you still want to invest overseas, right, you just put a lesser percentage in your portfolio for these type of companies. Okay.
Okay. There's another question. Most of the good US companies have very high valuations, especially very high PE ratios, and the PEG doesn't seem to work as well. So, what is your advice? I mean, what do you think about investing?
Okay, I think just now Adam had brought up this point. So you have to find the average PE of the company that they are trading
the
at.
Historical PE.
Historical average, yeah. So you want to buy it below the average price. Yeah. So because this is what I call stock market valuation. That means everybody have a value that price to that company already. So you just need to buy below the value that price.
And you have to remember that the US market is huge and the economy there is it's amazing, it's big. So you can't, I mean, a good company in Singapore could trade PE of 20. But in the US it can go up to 1,000.
Yeah.
Right?
Yes.
It's not uncommon to see that. Of course, if you're going to buy that, you're going to do some research. Same for, I mean,
and in US, some companies can be about 40, 50 Ps, but they are really growing at 40%, 50%. So, but because in Singapore we are much smaller, so I'll encourage you to invest overseas. Go and see the world. It's really, you can get much better companies out there as compared to the local Singapore, okay, or Malaysia.
Okay. How about this one? How can we analyze if a share buyback is genuine? So basically, the management thinks that the share is undervalued. Or are they doing it for price support? How do you tell?
Okay, firstly, you must know how to value the stocks. Okay, if you value the stock is undervalued and the management buying back, yes, he's doing it correctly. But if the stock is overvalued and the management still buying back, that is price support. Okay?
All right, let's see. Let's see, there's any more questions that we can answer? Okay. Is there anything that you want to get?
You can go back to the live questions.
Okay, let's go to the live questions. Just finish up with the live questions and see what we have, and then we'll wrap up. We're going to ask you a poll as well to basically ask you how would you like us to conduct a webinar like this in the future. All right, so it's basically whether you want to do a webinar like this that's live, or should we do it on Facebook Live?
So later we'll do a poll. Just type W for webinar.
No, as in there's going to be.
There's going to be a poll. Okay.
You're going to have some system.
Okay.
So basically, we'll ask you the question. I mean, that's the question. So we'll ask you a poll later. Let's just ask you a few more questions before we wrap up. How do you determine if a company has a durable competitive advantage?
Well, this is a very tricky question that you. Okay.
Sorry, I asked it.
Okay. So you must always if I like to analyze industry where there's a lot of competitors. So that's where you can see what this person do and what this person do. So let's say usually companies with dual have a good competitive advantage, right? They generally do have a much higher margins than their competitors. So you could analyze why this company is able to have much higher margin than this competitor.
Right.
Okay, and what's the reason? If you cannot find out the reason, right, generally it's more or less the fraud. Right? That's what happened to a lot of the Chinese listed company where their margin always higher than a competitor, but you don't know why. What's the reason why they are able to be higher than a competitor, and then they turn out to be a fraud. Right?
But basically, you can always tell that if the margins are. I mean, if we cover this in the articles on Fifth Person, basically when you see a company that has strong margins, it means that they'll be able to charge a price, premium price that customers are still willing to pay. Or their ROEs are very high as well. So these are some telltale signs in the financials that you can look. But of course, like Victor says, you need to go deeper and understand how do they achieve these margins, how do they achieve these results. All right, so that's important as well. All right, let's wrap this up with this question. Basically, this is for you, Victor. So how long did it take for you in your investment journey to reach this stage right now? Okay, was there a turning point where you felt that you basically felt that you had the expertise to invest successfully?
Yes, but it's after I think 6 or 7 years. That's a very long time. So you have to be in the market for quite a long time to get this experience. But in the meantime, you know, try to keep reading, keep learning, okay, and start investing. Don't be afraid to invest, okay. When if you make a mistake, learn from the mistake, okay. Yeah.
Okay, so with that, we will wrap up the webinar really soon. The last thing we would like to ask you is basically, how would you like us to conduct future webinars, live Q&A webinars like this? So basically, you want us to do a webinar like how you are experiencing right now. Basically, it's a webinar that you log into and then we answer your questions.
And you look at our face.
And you look at our handsome faces. All right. Oh.
Why are you laughing?
Usman is cringing over there. Okay. All right. Or would you like us to do this on Facebook Live? That's the question basically. Okay, so Facebook Live, I think it's open to everyone, to the public as well. All right, so I'm going to set the poll, and I'm going to load it, and please
start your vote.
Yeah, there's a vote that you can basically
you can make
your choice and let us know. All right, so with that, thank you so much for joining us for the last, I think, 45 minutes. All right, thank you for sending so many questions. We really couldn't cover everything. We did our best to answer as many as we could, and including your live questions as well. So with that, thank you very much, Victor, for being here tonight. Thank you.
Thank you, everyone.
Thank you for being with us tonight as well, and spending your time on a Thursday night with me and Victor. So thank you so much. We'll see you again. This is Adam from the Fifth Person. This is Victor, and we'll see you. Thank you so much.
See you. Bye.